Okay, let's unpack this. We're diving deep today into the source material you shared with us, and it's centered on, well, a book that's almost mythical among serious investors, Seth Klarman's Margin of Safety.
Mm-hmm. It really does have that kind of reputation.
Now, you might be looking at the publication date, 1991, and thinking, why are we digging into a book from, over 30 years ago? It wasn't even an instant bestseller, was it?
No, not at all. It was much more of a quiet ripple initially, but it grew into an absolute cornerstone for a certain kind of investor, that deep analysis, value-focused type.
That's right. Seth Klarman himself isn't like a household name like Warren Buffett, maybe. But within the circles that practice this really rigorous, risk-averse value investing, his name and his firm Ballpark Group's performance, they carry enormous weight.
Absolutely huge weight. And that's amplified by the book's scarcity. It's kind of legendary in itself.
We're talking first editions that are incredibly hard to find and sell for thousands.
Exactly. Thousands of dollars. It went from being largely overlooked to this coveted classic, almost a sacred text for some, because the core ideas have just proven to be incredibly resilient. They've worked through all sorts of markets.
It's that journey, isn't it? From quiet release to legendary status that tells you something.
It really does. It tells you the power here isn't about predicting the next hot trend or timing the market perfectly. It's about something much more fundamental, something timeless.
So our mission today, essentially, is to cut through that mystique. We're going to unpack Klarman's philosophy piece by piece, look at the wisdom captured in the source material you gave us, and see what enduring insights you can maybe extract and even apply.
Sounds good. Where should we start?
Well, to really get Klarman's perspective, I think we have to start by understanding what he was pushing back against in 1991. What were the fundamental sins of the market, the flaws in how people invested that he saw, and maybe how many of those are still causing problems today.
Yeah, that's crucial context. And it's frankly striking how relevant his observations from 91 still feel. He was challenging behaviors back then that, honestly, sometimes seem even more amplified now.
Okay, so what's the first big one?
First up, he drew this really sharp line between investing and speculation. He basically said that real investments, even if they take a very long time to pay off, they will eventually throw off cash flow.
Right, like owning a piece of a real business that actually makes money.
Exactly. But speculators, he said, they pay little heed to reasonable valuations, often chasing trends and sentiment-fueled momentum. It's about the price going up, not the underlying value.
He uses that great analogy, doesn't he? The trading sardines thing.
Oh yeah, the sardines. It's brilliant. People are furiously trading tins of sardines. The price goes higher and higher. But the fundamental question is, are these sardines for eating, or are they just tokens for trading?
Because if you're just buying them hoping someone else pays more later without caring if they're actually, rotten inside and nobody will ever eat them,
then you're speculating. Pure and simple. You're not investing. You're buying something without any real grasp of its underlying worth or its ability to generate cash down the line.
Yeah, okay. And that ties into the next point, right? The role of emotion.
Definitely. Fear and greed. He saw them as these massive forces driving market cycles, pushing prices way out of line with actual value. His observation was pretty stark. Successful investors tend to be unemotional, allowing the greed and fear of others to play into their hands.
It's interesting, he's talking about this from a very practical, boots-on-the-ground investment angle. But around the same time, you had academic fields like psychology really digging into behavioral finance, formally exploring how biases mess up our decisions.
Right. It really underscores that these aren't just minor quirks. They are core drivers of why markets get dislocated, why things get mispriced.
Okay, so speculation, emotion. What else was he fighting?
He also really attacked the illusion of precision, especially this over-reliance on forecasting. He was incredibly blunt about it.
What did he say? Something like,
in reality, no one knows what the market will do. Trying to predict it is a waste of time, just flat out. And when it came to valuing businesses, he warned that any attempt to value businesses with precision will yield values that are precisely inaccurate.
Precisely inaccurate. I like that. It's a call for humility, isn't it?
A huge call for humility, because the future is uncertain. Pretending you can pin it down with decimal point accuracy isn't just pointless, it's dangerous. It gives you this false sense of security.
Right. And the last big sin.
Herd behavior, the tendency we all have to just, follow the crowd. He acknowledged, sure, it's always easiest to run with the herd, yet distancing yourself from the crowd is an essential component of long-term investment success. You have to be willing to stand apart.
And looking around today, These weren't just problems of 1991, were they? Rampant speculation in certain assets, disconnected from cash flow. Check. Fear and greed whipping markets around? Check. Analysts making super precise forecasts about things no one can predict? Check. And herd dynamics. Oh boy.
Absolutely. Arguably, things like the pressure for short-term performance might even intensify some of these tendencies today. So Klarman was identifying these perennial human and market flaws.
Okay, so if those are the problems, speculation, emotion, false precision, herd mentality, what's Klarman's big answer? What's the core idea, the central thesis of margin of safety?
It's right there in the title, and probably his most famous line: avoiding loss should be the primary goal of every investor.
The primary goal, not just a goal.
Primary goal. And then the way to avoid loss is by investing with a significant margin of safety.
That's a fundamental shift in thinking for a lot of people, I imagine. It's not just trying not to lose money casually. It's the absolute number one objective.
Exactly. Protecting your capital from permanent loss comes first, always. And his view is that attractive returns, they aren't something you chase by taking on huge risks. They are the byproduct of successfully managing risk and, most importantly, avoiding those permanent losses.
So avoiding loss is actually the path to profit.
That's his argument. He states, is the surest way to ensure a profitable outcome. If you rigorously protect your downside, the upside, over time, tends to take care of itself. It's the polar opposite of high-risk, high-reward strategies.
Okay, so that's the core thesis. But like any philosophy, it must rest on some foundational beliefs, right? What has to be true about markets for this whole approach to even make sense? There must be some unspoken assumptions under the surface.
Yeah, definitely. You can tease out at least two core beliefs that underpin everything.
What's the first one?
The first is absolutely fundamental. Klarman believes markets are not always efficient. He completely rejects the idea that prices always perfectly reflect all available information all the time.
So the efficient market hypothesis.
He explicitly says that market inefficiencies caused by human behavior and institutional constraints create opportunities for value investors. He even argues value investing itself is predicated on the proposition that the efficient market hypothesis is frequently wrong.
And why are they inefficient, in his view?
It comes straight back to human behavior. Psychology. He sees psychological influences, fear, greed, overconfidence, the herd mentality we just talked about, as a dominating factor. He says they matter as much as, and at times more than, underlying value in determining securities prices.
Wow. So those emotions aren't just noise. They're actually what create the opportunity.
Precisely. They create the mispricings, the assets trading way below what they're truly worth that value investors are hunting for. His entire strategy hinges on markets being irrational sometimes, driven by emotion and structure, and crucially, that these irrationalities create gaps you can exploit. You just have to accept that the market isn't some perfectly rational machine.
Okay, that's a big one. Assumption number one. Markets are often inefficient and psychology-driven. What's the second key assumption?
It's about value itself. For this whole concept of a margin of safety to work, there has to be something real, something tangible, or at least estimable to measure that safety against.
Meaning there has to be an actual intrinsic value.
Exactly. Klarman assumes businesses possess an intrinsic value, an underlying economic reality that's separate from the constantly fluctuating stock price. To him, stocks aren't just ticker symbols. They represent fractional ownership of underlying businesses.
But he admits it's not easy to figure out that exact value, right?
Oh, absolutely. He's very upfront about that. He calls valuation an imprecise art. There's no magic formula spitting out a perfect number. But the core belief is that a conservative, rational estimate of this intrinsic value can be made. You can get in the ballpark through diligent, bottom-up analysis.
Okay, so you estimate the value conservatively, but there's another crucial piece, isn't there? You have to believe the market will eventually see it too.
That's the critical underlying faith. Implicitly, you have to believe that eventually, the market will eventually recognize it. As he notes, value investors buy assets for less than they think they're worth, and then they hold them until their true value is recognized by the market.
That really is a leap of faith, in a way. Believing that despite all the short-term craziness and noise, things will eventually revert to some kind of fundamental economic reality.
It is. Without that belief in eventual convergence, in long-term rationality, winning out, just buying cheap stuff and sitting on it wouldn't make much sense. It would just be buying cheap stuff.
Okay, so those are the foundations. Markets get irrational, but intrinsic value is real and will likely be recognized eventually. How does Klarman translate that into a practical system, like a mental operating system for actually doing it? Let's get into the pillars of his approach.
Right. So the absolute bedrock, the first pillar, is that primacy of capital preservation we touched on, achieved through the margin of safety.
Rule number 1, thou shalt not suffer big permanent losses.
Exactly. It's not just a preference, it's the core objective, because as he says, the avoidance of loss is the surest way to ensure a profitable outcome. And mathematically, it's just brutal. If you lose 50% of your capital, you need 100% gain just to get back to even. Avoiding that hole is way easier than digging out of it.
And the tool is the margin of safety, that buffer.
That deliberate buffer between the price you pay and your conservative estimate of intrinsic value.
He uses that engineering analogy, right? Building a bridge.
Yeah, the classic Graham and Dodd analogy, which Buffett also uses. Build a bridge designed to hold 30,000 pounds, but only drive 10,000-pound trucks across it. That massive 20,000-pound difference, that's your margin of safety. It protects you against errors in your analysis, against plain bad luck, against unexpected market swings.
But what's really striking with Klarman is how big a margin he demands. It's not just a little bit of safety.
No, his rigor here is intense. He's aiming for discounts as high as 50% or more to a business's intrinsic value estimate. That is a huge buffer.
And demanding that kind of massive discount must really narrow down where you can even look for investments, right?
Absolutely. It acts as this incredibly powerful filter. Where on earth do you find decent assets trading at 50% or more below a conservative estimate of their value? You're not finding that in the popular, widely loved, heavily analyzed stocks.
So it forces you into the dark corners.
Pretty much. It forces you to look where others are running away from or just completely ignoring. Things like distressed debt, complicated spin-offs, industries totally out of favor, companies tied up in litigation, situations of extreme dislocation or neglect.
Which probably feel riskier or are harder to analyze.
Often, yes. They might be less liquid, more complex. This pushes you towards being contrarian, doing really deep, difficult due diligence, precisely because the reasons for those huge discounts are rarely simple or obvious. The strict requirement forces you to investigate where the herd isn't grazing.
Okay, pillar 1. Preserve capital with a massive margin of safety, which forces you into neglected areas. Pillar 2 must be about actually finding those opportunities, right? The toolkit.
Exactly. How do you find them? It starts with intense bottom-up fundamental analysis. Forget macro predictions, forget market timing. Focus on researching individual companies, individual securities. Dig deep.
And when it comes to valuing them, you said conservative before.
Deeply conservative. He emphasizes that valuation should always be performed conservatively, and specifically mentions giving considerable weight to worst-case liquidation value, alongside other methods. He even had a stated preference, especially earlier, for tangible assets, because you could estimate their liquidation value with maybe a bit more certainty.
And the name itself, margin of safety, why is that term so central?
Because it embodies that mental shift we talked about. It directly confronts the flaws in how people often invest, focusing only on potential return, ignoring risk, ignoring the fact that valuation is imprecise. It forces you to ask that crucial first question, how much can I lose here? Before you even dream about how much can I make.
It's like built-in humility, room for error.
Perfectly put, built-in room for error, a constant reminder. Your analysis isn't perfect, the future's unknowable, you will make mistakes.
But he says it's not enough just for something to look cheap on paper, right? You need to understand why it's cheap.
Yes, that's a really critical part of his toolkit. Don't just find something that looks undervalued statistically. You have to figure out why it's trading at that discount. Is it forced selling by institutions that can't hold it? Is it irrational prejudice against the sector? Is it just too complicated for most people to bother with? Or are there temporary, solvable problems?
Does knowing the why help?
Immensely. He says, we consider for each of our investments not only whether a security is undervalued, but why it is undervalued. If the reason is that there are uninformed or emotional sellers, we become more comfortable. Understanding the source of the mispricing gives you the intellectual conviction to go against the grain. It gives you confidence that maybe this gap will close eventually.
And he also looks for catalysts, things that might help close that gap.
Right. Potential catalysts. These are specific events that could unlock the value and narrow the discount between price and intrinsic value. Things like a planned spin-off, an asset sale, the resolution of a lawsuit. Catalysts aren't absolutely essential for him, but they're definitely a plus because they can potentially shorten your holding period and reduce risk by giving you a clearer path for that value to be recognized.
So this whole toolkit, conservative valuation, understanding the why, looking for catalysts. It seems like it's all about prioritizing a solid process over hoping for a lucky outcome.
Exactly. You build a systematic way to find and evaluate opportunities. You know not every single pick will work out perfectly, but you trust that the rigorous process tilts the odds heavily in your favor over the long run. And being super selective, saying no to most ideas, is a core feature, not a bug.
Okay, so you have the goal, preserve capital, the tool, margin of safety, the methods, toolkit. But then there's the really hard part, actually doing it, especially when markets are going crazy. This brings us to the psychological armor, right?
Absolutely. This is often the hardest part. Klarman spends a lot of time on investor psychology because, frankly, it's where most people stumble. He observes, again, successful investors tend to be unemotional, allowing the greed and fear of others to play into their hands. He's acutely aware of all those cognitive biases, overconfidence, anchoring, and that powerful herd instinct.
He basically says temperament is as important as analysis.
At least as important, maybe more so in practice. This psychological armor, this resilience, it's built on several key qualities.
Like patience.
Patience is non-negotiable. Value investing is often a waiting game. Buy cheap, then wait, sometimes for years, for the market to catch up. And that includes the patience to hold large amounts of cash when good opportunities just aren't there. Seeing cash not as a drag, but as ammunition for future opportunities.
Discipline, too, I imagine.
Crucial. It's so easy to get tempted by the latest fad or feel pressured by what everyone else is doing. He talks about the continuous effort to remain disciplined, sticking to your criteria, sticking to your thesis, even when it feels lonely or uncomfortable.
And being willing to be lonely brings us to contrarian thinking.
Fundamental. As he says, value investing by its very nature is contrarian. You have to be willing to distance yourself from the crowd, to buy what's unloved and overlooked. That requires real independence of thought and conviction when everyone else thinks you're nuts.
And you need intellectual honesty to admit when you're wrong.
Vitally important. Acknowledging your own mistakes, acknowledging the limits of your knowledge. The whole idea of margin of safety is rooted in that honesty. Valuation is an imprecise art, the future is unpredictable, and investors are human and do make mistakes. You need that humility.
It sounds like he sees this temperament not just as helpful, but essential. Like you can't even do value investing without it.
That's exactly his view. It's a prerequisite. Without the right psychological makeup, the patience, the discipline, the contrarian impulse, the humility, even the most brilliant analysis is useless. Why? Because you'll inevitably abandon your strategy at the worst possible moment, usually when fear or greed takes over.
Has he ever talked about whether it's nature or nurture? Can you learn this stuff?
He's mused about it, yeah. Sometimes suggesting it might be partly in your blood or genetic, but mostly it seems to be about consciously cultivating a disposition, a mindset that aligns with the tough demands of this approach. Contrarian, long-term, risk-averse, often solitary. It's like building a psychological fortress. And the margin of safety itself actually helps build that fortress. It provides psychological comfort, reducing anxiety so you can be rational when everyone else is freaking out.
Okay, so we've got the foundations, the system, the mindset. But this book is from 1991. How do these ideas hold up today, in these super fast, tech-heavy markets? Where do they get stressed or maybe even bend a little? Let's put them to the test.
Right, the stress test. Because applying these principles, especially to businesses that look very different from the industrial companies of 1991, definitely requires thought and some adaptation.
Like take a giant tech company, maybe Alphabet, Google. Ballpost has owned it, even increased its stake at times. That might seem counterintuitive for traditional value, or how does that fit?
Well, you have to go back to Klarman's core principles. First, cash flow. Companies like Alphabet are absolute cash-generating machines. They clearly fit his fundamental definition of an investment, a business that throws off cash. He's not buying it based on hype. He's buying a slice of an incredibly profitable enterprise.
Okay, so the cash flow's there. What about value and margin of safety?
He's still looking for the same things. An estimate of intrinsic value, a strong competitive moat. Think about Google search or YouTube's dominance, and, crucially, a mispricing. Even with a huge, widely followed stock like Alphabet, he might perceive a gap between the market price and his conservative estimate of its future cash flows. Maybe that gap is caused by temporary market negativity, fears about regulation, or maybe the market just isn't fully appreciating how durable that moat really is.
So it's not about chasing growth for growth's sake.
No. It's about investing in a high-quality, cash-generating business if and when he believes it's available at a price offering a sufficient margin of safety. It demonstrates that the framework can be flexible and adapt to different kinds of assets as long as those core tenets, cash flow, estimable value, buffer, still apply.
And where does the philosophy really show its strength? Probably during market panics.
Absolutely. Moments like the 2008 financial crisis are where this approach shines. Klarman is famous for having the readiness and, crucially, the capital to act decisively when everyone else is paralyzed by fear or forced into selling.
And that comes from being willing to hold cash.
Directly from it. His willingness to hold substantial cash reserves, sometimes more than half the portfolio.
Right.
People call it cash drag in bull markets, but he sees it as essential ammunition. It protects the fund when markets fall, and it provides the firepower to go bargain hunting when fear and forced selling create those incredible, indiscriminate mispricings.
Because panics are driven by exactly the stuff he talks about, emotion, institutional constraints.
Precisely, creating massive inefficiency. He famously capitalized on the chaos of 2008, buying distressed assets at cents on the dollar because he had the cash, the mandate, and the temperament to step in when few others could or would.
Okay, clearly powerful. But it's not foolproof. Where does the model face real challenges today? Where does it bend?
Yeah, no strategy is perfect. One major challenge is the flip side of holding cash. Those long, grinding bull markets. When truly undervalued securities, those 50% plus discount types, are just really hard to find, his discipline means holding cash.
Which means underperforming the market.
Right. It inevitably leads to underperformance versus benchmarks that stay fully invested. That cash drag severely tests investors' patience, it has a real opportunity cost, and for professional managers judged on quarterly numbers, it creates significant career risk.
What about valuing modern businesses, all the tech and intangibles?
That's another big one. Traditional value often leaned on tangible assets factories, inventory. Valuing businesses heavy on intangibles, intellectual property, network effects, brand value, user data is much harder. Klarman and Baupost have obviously adapted, but the imprecise art of valuation becomes even more complex, more reliant on judgment and projections when the assets aren't things you can easily touch or count.
And there's always the risk of the value trap, isn't there?
Always. The perennial fear. A stock looks cheap based on the numbers, but it just stays cheap or keeps falling because the underlying business is actually in permanent decline or the industry is fundamentally impaired. Understanding why it's cheap and looking for catalysts helps mitigate this, but it's a constant challenge for any value investor. You can still be wrong about the future.
What about size? Baupost is huge now. Does that make it harder?
Definitely a factor. For a multi-billion-dollar fund, finding opportunities that are large enough to make a meaningful difference to the overall portfolio and still offer that deep margin of safety gets tougher. If they try to buy a large stake in a smaller, undervalued company, their own buying can push the price up, eating away the very margin of safety they were seeking. Klarman himself has noted that huge funds often have to ignore smaller companies where value might lie, simply because the position size wouldn't move the needle for them.
And finally, what about this whole value versus growth debate? Hasn't value as a style underperformed for quite a while now?
That's a broader headwind for sure. There's been a widely discussed trend, especially since maybe 2007 or so, where growth stocks have generally outperformed value stocks for long stretches. Now, Klarman is a bottom-up stock picker, not a factor investor per se, but when the broad style is out of favor, it can still make it harder to find those extreme dislocations he looks for. It creates a tougher environment if the market is consistently rewarding momentum and growth over statistical cheapness.
So the model definitely gets stressed where it bumps up against short-termism, momentum, and the difficulty of valuing the new economy. The strengths, patience, cash become perceived weaknesses in certain markets.
Exactly. It becomes a real psychological test, and it highlights the need for continuous adaptation in analytical tools, especially around intangibles, while still holding firm to those core conservative principles.
Okay, so we walked through the problems Klarman saw, his core beliefs, the practical toolkit, the psychological armor, and the modern stresses. How does this all fit together as a system?
It forms this really coherent, integrated system. It's not just a collection of tactics. It's a complete framework for thinking about making high-stakes decisions when you know you don't have all the answers.
A system that prioritizes.
It consistently prioritizes deep, independent thought over just following the crowd. It prioritizes long-term resilience and survival over grabbing quick, potentially risky gains. And it demands rational assessment over letting your emotions run the show. It's about structuring the game, whether it's investing or something else, to focus intensely on what you can control. your own research process, the price you're willing to pay, your own behavior, not obsessing over what you can't control, like predicting market swings or the exact future.
It's a commitment to being, as you said, the thoughtful investor.
Or just the thoughtful decision maker, really.
Okay, final challenge. If you had to boil everything down, strip away all the specifics, and just steal one mental tool from margin of safety to install in your brain, what's the most essential takeaway?
Oh, that's easy. It has to be the margin of safety mindset.
A mindset, not just the calculation.
Far beyond the calculation. Think of it as a fundamental philosophy, a core heuristic for navigating life. The deliberate, conscious habit of building a substantial buffer, a cushion against the unknown, against the unpredictable future, against your own inevitable fallibility, against bad luck, against potential negative changes in any significant thing you undertake.
So it's about internalizing those realities we talked about. That valuation is imprecise, the future is unpredictable, we all make mistakes.
Yes, and building protection against those realities right into your initial plan, your initial decision. It's about constantly ingraining the habit of asking yourself, okay, what if I'm wrong about this? How much room for error have I actually allowed myself here?
Why is that mindset so powerful? Not just for stocks, but generally.
Several reasons. First, it ruthlessly prioritizes survival. Resilience comes first. Avoiding those huge permanent setbacks is paramount because remember, compounding works viciously in reverse too. You absolutely have to be around for the long run to benefit from it.
Okay, survival first. What else?
It explicitly manages unknowable risks. It's a built-in acknowledgement that there's tons we don't know and can't predict. That buffer protects you from the surprises, the black swans, the things you didn't see coming.
It sounds like it forces discipline, too.
Absolutely. Demanding a real margin of safety forces you to be patient. It stops you from chasing fads, from overpaying just because something's exciting, from rushing into commitments. Why? Because those situations rarely come with a built-in buffer. They're often priced for perfection.
And does it help with the stress, the psychological side?
Profoundly. Knowing you have that cushion provides genuine psychological comfort, as Klarman calls it. It makes it so much easier to stay rational and stick to your plan when things get scary or volatile because you're not operating right on the edge. You have breathing room.
And you said it's universal.
Well,
beyond finance.
Completely. This is where it really transcends investing. Think about an engineer designing a bridge with extra strength, way beyond normal load, or a mountaineer packing extra food and supplies for unexpected delays, or a military strategist planning for contingencies for things going wrong. It's the exact same principle. Building a buffer against potential failure or adversity. As many people have pointed out, it's simply wise to build in margins of safety in all areas of life.
So the margin of safety mindset isn't just an investing technique.
Not at all. It transforms into this fundamental heuristic for navigating any complex system where things can go wrong. It's about embedding proactive prudence, caution, and resilience right into how you make decisions, accepting that the future is messy and unpredictable, and giving yourself the best possible shot to not just survive the bumps, but actually thrive over the long haul.
Seth Klarman's Margin of Safety, then. It's way more than just an investment book from the early 90s. It feels like an intellectual toolkit for becoming a more thoughtful, more resilient decision maker, period.
I think that's exactly right. By relentlessly demanding that buffer, by cultivating the discipline and patience and independent thought required, you don't just become a better investor. You build a stronger foundation for dealing with challenges just about everywhere.
Well, that really wraps up our deep dive into the source material you shared. Thank you for bringing this fascinating book and its ideas to our attention, and thanks to you, our listener, for joining us for this exploration.
It was a great discussion. These ideas really hold up.
They really do. And this framework, it really offers a different lens, doesn't it? A different way to look at so many decisions we all face, way beyond just finance.
Mm-hmm.
So here's a final provocative thought for you to chew on after this deep dive. Where in your life, right now, could applying a margin of safety principle, consciously, deliberately building in a buffer against potential downsides, make the biggest, most meaningful difference?
Good question to ponder.
Join us next time as we dive deep into another set of fascinating ideas. Until then, think softly.